Well, welcome to the 2025 Wisconsin update for Back to Basics. Got a few items to go through here before we get into the material itself. One is more of an update, and that's really from coming from the Wisconsin CPA Society. I've got a letter, and I thank Scott from Stevens Point for sharing this information with me. Wisconsin CPA Society, Tammy Hofstad, the president, met with the Department of Revenue dealing with the QCDs. It was actually more than just QCD. I think it was also public retirement. The gist of the letter, and most of this was for the qualified charitable distributions, there was an audit done by the Wisconsin Department of Revenue, and they were looking at 21 and 22. Now, a couple things came out of this meeting back in October. If someone was audited for both years, they can file an appeal for basically just 1 year. If that's cleared, they won't hound you for the second year. Another important point, some clients might have gotten the letter, assumed that they did something wrong, paid the tax, not realizing that they did nothing wrong at all. If that's the case, file for an amendment to get that back, again, with the documentation showing that it was a proper transaction for the QCD. The money went right from the IRA to the charitable entity and did not go come to into the hands of the taxpayer. That's really what they're looking for. The state kind of rolled that out pretty poorly, and a lot of people got cut in the wash. They said that it was, I've heard rumors that it was for only people that did large qualified charitable distributions. However, at one location in Brookfield, an individual said that he had a client that received an audit letter from the state, and the amount was less than $3,000. So, for what it's worth, I don't think they went after just the big QCDs. They just didn't I guess, addressed that very well when they sent it out. So that's kind of an update there if you had a client that did a qualified charitable distribution. Okay, so the material, a couple reminders here when we get into the Wisconsin material. They're always lagging from the state. The federal passed the One Big Beautiful Bill Act in the midpoint of 2025, and we're looking at IRS, basically the code as of the end of 22. So it certainly does not have a lot of the provisions inside the One Big Beautiful Bill Act. Of course, there's a couple of exceptions. We'll talk about that. We talk about depreciation. They're even further behind when it comes to depreciation at the state level. They're looking at what was in force for the Internal Revenue Code as of 2014. Again, some exceptions there, but one of the biggest ones, and that was the biggest provision on the business side, is bonus depreciation at the federal level, not recognized at the state level. So if someone's aggressive, they take the bonus depreciation for federal, which they're entitled to do, as long as they bought the asset after January 19th and placed that in service before the end of the year. You've got the bonus at 100% for federal purposes, even if they bought it before then and they had to use the 40% for federal. Neither one is recognized for state of Wisconsin. What is recognized at the state level would be it was Section 179, and at the federal level now is at 2.5 million. So it pretty much covers most small businesses if they're looking to buy and expense some equipment. So that facilitates no Schedule I adjustment if they use Section 179. Now, Wisconsin law versus in some of the updates that we're about to get into, the biggest one where we'll spend most of our time is on the new subtraction. But there's a couple other things I want to hit first. The expansion of the second tax bracket. This is the income threshold where that second tier is for taxable income. I'll show you on the chart the changes. Uh, Basically, the concept is more people are going to be taxed at that second bracket before the third bracket kicks in, and I'll give you those breakpoints in a few slides as we get down the road. The new retirement income subtraction. This is where we're going to spend the bulk of the time because it is new. This new subtraction modification for eligible retirement income. We had an adjustment of $5,000, but that is kind of more than doubled when we talk about the exclusion here. much higher limit. We talk about when is it effective? That's for 2025. So that's for this filing season. So the old provision had income thresholds, phase outs. If you're a high income individual, this doesn't have those restrictions tied to it. Essentially, this is an age-based deduction. So taxpayers that are 67 by the end of the tax year get to use this subtraction on qualified income. So the individual filers can subtract 24,000 of retirement income. If you're married filing joint, both spouses are 67 or older, you can subtract 48,000. So that's a pretty big deal for the retired couples. This application basically is looking at the full 48,000 for married couples, regardless of which spouse has the income. So if spouse A has $40,000 of retirement account, spouse B takes 10,000 from the IRA, that's 50,000 retirement income with a subtraction of 48,000, leaving very little be taxed at all to the state of Wisconsin. And we'll talk about some of the restrictions if you decide to go this way, because it is a choice, and we'll go through the mechanics a little bit. But where it's taken on the tax return, the Schedule SB, so the subtraction form for the state of Wisconsin. So line 16 is where this is going to come off if it's qualified. So basically, it has to be taxed at the federal level, qualified retirement income. So who gets this, who doesn't, and how does it work if you're a part year resident? Well, the full year residents can claim the full amount. So the 24,000 or married, if both are eligible, 48,000, no problem for full year residents. If you're a part year resident, you have to prorate based on your Wisconsin income versus the federal income. And this is something that's not available to non-residents. So they're not eligible for this at all unless if they're a non-resident rather. The qualified retirement income. This is going to be your basic 401k, 403b distributions, 457 plans, simples, SEPs, IRAs fall into this category, and pensions as well are all qualifying retirement income for this subtraction. Important note here, we don't tax at the state level the Social Security benefits or railroad retirement benefits. So if it's not taxable, for Wisconsin in the past, that's not part of the subtraction. Doesn't count towards this limitation that we're talking about. Here's the Schedule SB and where it comes in. And if you see on line 16 at the very end, in parentheses, it says credits restricted. So this is where we need to maybe do some math for our clients, because it's an all or nothing. If you claim the subtraction, you can't claim any other credits. So that's any credit on Schedule CR, anything on lines 13 through 20, and lines 30 through 35 on Form 1. So there's a litany of tax credits that you're going to have to compare what's the best course of action for your particular client. Itemized deduction credit, homestead, property, school property tax credit. The married couple credit, they have to be working. Both couples have to be working, get the married couple credit. And at 67, you could have some people that are still working. However, it's case by case basis. Retired veterans property tax credit. Now that's a big one. And for those people that are eligible, I don't know if I would take the subtraction. This is where you have to do the math to see what works out the best. Here's the other concept with this all or nothing. You're foregoing any credit that would have been computed in 25, including any amount that would be carried forward into 2026. And you're unable to utilize any credit that's carried forward, say from 24, to offset the 25 income. So, it's not a quick determination that you can just look at the taxpayer's numbers and decide. I think you're going to have to play around with the software a little bit. I haven't seen how Drake is going to apply that. My assumption, and again, I won't know until I get a chance to look at the software. Um, my assumption is if you don't take the subtraction, they'll apply the credits as normal that you're entitled to, whether it's the property tax credit or the itemized deduction credit on the state level. Unless you go back in and then do the subtraction on line 16, Schedule SB, I'm assuming at that point, then all the other credits would be taken away. So you can take a look at what the net result is either way. So I'm looking forward to the software um, as I get a chance to look at that just before tax season starts. So basically, you're going to have to compare the math. Taxpayers have to basically take a look and see what's going to save more money in the long run. I put it together a checklist in the material designed to help taxpayers make this determination. So list all of I've listed some of the credits, but list all the credits they're giving up versus the subtraction to determine which is the best course of action for them. But that's by far the biggest change at the state level. If you take the subtraction, a couple things to keep in mind. Yes, you get to take that subtraction up to 24,000, or if married, 48, but you're going to lose out on those credits. This is probably the best way to go for high income retirees with large IRAs and few itemized deductions. So the itemized deduction isn't very high. On the other side, you take the credits. If basically you're low income, you're getting homestead, that's a pretty big one. Also, if you're a disabled vet and you've got that property tax credit for disabled vets, if you're both working after 67, you're the married couple credit, these things all start to add up, and it may look better for those individuals in that situation. But again, case by case basis, you're going to have to take a look and determine what's best course of action for your clients. The increased subtraction for adoption expenses. This is another step up here that we had an increase from 5,000 to 15,000 for each child. And this is another change where it comes in on Schedule SB, line 20 of that schedule. Child and dependent care credit. This is expanded to 100% of the federal credit. So that's up from 50% to 100. The maximum qualifying expenses are at 10,000 for one child, 20,000 for two or more. So pretty favorable numbers there when we're talking about anyone that has daycare operation where their kids are in daycare where they're working. A couple other things from the state of Wisconsin, and we spent some time here in the past, but it is such a big one. And we talked about taking that subtraction earlier. This is one where if they are eligible for the veterans property tax credit, they probably are not going to use that subtraction. Again, you have to determine what's best for them by just running the numbers. This is something that is not automatically given, even though someone might be a disabled vet, they have to get certified through the Wisconsin Department of Veteran Affairs. So basically, the concept is you're going to get a credit equal to the amount of the property taxes paid on your principal residence that has to be in the state of Wisconsin. So it's eligible for eligible veterans can qualify, even the eligible unmarried surviving spouses. There's a caveat with that category, and I'll circle back to that in a minute. You have to reside in Wisconsin as your principal dwelling. Doesn't mean you couldn't have a second home in another state, but your primary residence has to be here in the state. The credit must be claimed within 4 years, and that's the unextended due date of that Wisconsin tax return. So here's an example. We're talking about 2021 income tax return. That's due April 15th of 2022. So the VA sometimes takes a while to make these determinations. And whether it's the veteran or the surviving spouse, if they're eligible, they have until April 15th of 2026. So the 4 year clock is ticking from the unextended due date of that particular tax return. So keep that in mind if you have a client that's in that process. Sometimes it can take over a year to get this thing approved. Surviving spouses. Now, this is the one I told you I'd circle back on. When we're talking about surviving spouse, they don't automatically get it when the veteran passes away. If he or she passes away, the surviving spouse has to reapply. They have to, state wants to verify that you meet the eligibility requirements. For example, you haven't remarried. You have to remain unmarried. And again, the second criteria is you have to stay in Wisconsin. There are some situations where I had a client that, well, once her husband passed away, he was the veteran that made them eligible for this. As a surviving spouse, she would have been eligible. However, she changed her principal residence and moved to Florida. So she wasn't living here for the majority of the year. So it's not just that they're single, they have to remain unmarried, but they have to reside here in the state. Verification basically starts uh, the process off. You have to get that certification before you file for this. So include that certification once you get that the first year you're going to apply for this, and then keep records obviously in your client file. The Wisconsin Department of Veteran Affairs is the toll-free number and the address here on page 9 in your material. This is basically um, where you can get additional assistance if you've got questions. The Form WRA, this is required attachment. If you're going to claim this credit, you have to have this mailed in within 48 hours of acknowledgement. So before the Wisconsin is going to accept it, they want to see that. Um, Refunds will not be processed until that WRA and its attachments are received. Now, there's a caveat. If you can get this documentation in via electronically, so scan it and send it in, that will be sufficient as well. But basically, it all comes to a halt unless they get that certification. So make sure you've got the proper paperwork in place before you submit that. Now, a couple things on identity theft. That seems to be a hot ticket both at the federal and state level. I just want to touch on some of the basic information here. If there is a data breach in your office, of course, for federal purposes, you have to have a written information security plan. And that basically is a step-by-step guide on what you do if, God willing, or God forbid, that something happens and there's a data breach in your office, you're to first notify the local stakeholder. Well, it used to be Michael Smith in Wisconsin, but right now we have a generic area six. There's no, it's not a toll-free number, but there is a phone number for the IRS for the stakeholder, and then the uh, email. The contact information is here in your material on page 9 as well. You also have to notify the states in which you prepare other returns. So it's not just Wisconsin that has to be notified. If you're doing returns for Minnesota or Arizona, perhaps you have a snowbird, those individuals have to be, or the states need to be notified there as well. So there's additional information in the Federation of Tax Administration report a data breach. Uh, there's also a publication, the number escapes me now, but there are steps that you need to follow if there is a data breach of client information. You should notify local law enforcement and basically security experts to find out how they hacked in perhaps into your company and your software so it doesn't happen again. Obviously, you want to make sure that everyone um, is notified here. Wisconsin statutes require most businesses to notify individuals if there's some type of data breach and their personal information is out there. So that's uh, a a little guide or step by step on the things that you need to do. This is how it's reported as far as the state is concerned. Identity theft declaration. They want basically an explanation, the reason you're filing the form. Obviously, there was a data breach perhaps in your office. You can see in section D, employer, or in this case, tax preparer data breach. They want to know the details. And section F, did you or did you not give consent? Um, Obviously, if there's false tax returns being filed by someone out there, they didn't give consent for that. But that's just the form that needs to be filed. I think we've gone over some of that ground before. I just want to hit you with a couple of common mistakes for the Wisconsin tax returns. I think the number one, I don't know if these are a particular order, but the number one that I have listed here is property taxes. They're not paid before the end of the year. Remember, you can't deduct them if you pay them in year two, you can't deduct it for year one. So the other mistake that I see is any assessments or charges for services such as garbage pickup or sewer. That's a lot of times buried on the property tax bill. Clients will fill out their client organizer and put the total amount down. It's always a good idea to take a look at that bill to make sure that you've got just what the property taxes, net property taxes, reflect on the tax return. Estimated tax payments don't match what the department has. We'll come back to that one a little bit later. There is a way you can look that up, and that comes in real handy because there are some situations where clients swear that they've made all the payments when in fact maybe they missed one or didn't make the full payment as they originally tell you during the tax appointment. Make sure that if you are taking a credit for another state, tax is paid, you attach a copy of that tax return. Wisconsin's not going to give you a tax credit unless you can prove that a tax was actually paid to another state. So any K1s from other states, we'll make sure that all of that is attached with the tax return. So again, some can go scanned and electronically sent in, but they need that information. A couple other things on worker classification. If you're dealing with any businesses, correct classification has kind of a ripple effect. Not only federal unemployment, income tax, withholding, and reporting for W-2 versus 1099. Wisconsin unemployment insurance, there's a huge impact there, and income tax withholding on the information that is supposed to be or is reported on the tax return itself. A couple other things that on the update front, the subtraction for the Edvest, the college savings account, is 5,130 per beneficiary for this year. Tuition and fee subtraction. Now, this isn't for everyone. There is a phase out. So if your income is too high, there is kind of a phase out there. So at 138,960 for married filing joint, that's where it phases out completely. If you're under that 111,160 for married filing joint, you don't have any kind of reduction. And that has jumped from 7333 to 7,649 for this year. A reminder on the due dates for the extensions, pretty straightforward. Both federal and state kind of mirror each other. Mid-April, again, the 6-month extension is there as well. You've got your update for the corporations, both C&S corporations. The Wisconsin level, this differs a little bit. The extension for federal is to October 15th, where it's November 17th for the 7-month extension for the state of Wisconsin. Same thing for the S corporation. They go from September 15th to October 15th because of the 7-month provision there. But otherwise, they pretty much mirror what's going on at the state level. Now, the corporate estimates for the state, both C and S corporations, the April, June, September, and December, not January here. That's available for individuals' partnerships, where you get that fourth quarter estimate in the 15th, January 15th of the second year. Here's the tax rates that I kind of alluded to before. You take a look at the second income level, the 4.4% starts at 14,680, runs to 50,000. Take a look at what last year's was. It capped out at 28,640. So if you go back, not only did they raise it a little bit as far as where that second tier starts, but the phase or the maximum amount doesn't kick in until it's over 50,000 and change. So a lot more generous there on the state side. The individual tax rates, again, same concept. Last year it kicked in at 28,641. It was at the 5.3%. If you take a look at where we're at now, 67,299 in your is the very top end of the 4.4%. So a little bit of a change there. Information returns, we take a look at W-2s, 1099s. Remember, those are due, have to be in the mail by the 31st of 2026. That's both federal and state. And you can request a 30-day extension, but it's not an automatic extension. Couple of reminders here for the account number when you're putting in information should have that 15-digit Wisconsin tax account number that starts with 036. But if the pair does not have a withholding account, they can use 10/8-01. And when we're talking about matching this, the legal name must match exactly what they have at the Wisconsin Department of Revenue website. Sometimes one word could reject it. Wisconsin estimated tax payments. This is where I said before, if your client swears they made the payments and sometimes it comes back and it doesn't match, you can look this up. So when in doubt, this is a great website to and use this as a resource to look it up. If you're going to go to the website, you just need a couple of things to verify. They'll let you in. Taxpayer Social Security number, of course, and estimated tax payment amount or the Wisconsin income from the prior year. So this information, you have that, you can get the information, move on, and it saves trouble down the road. So if a client starts questioning whether they made the payment or not, this is a great place to start. The other thing is, if they're in doubt, verify. is you're probably going to have problems at the federal level too. If they Wisconsin estimates don't match, it's likely they didn't make the federal payments either. So make sure you press them on that a little bit and verify when the client is not 100% sure. Couple of important notes here on the 1099-G will only be mailed to those people who do not have access to the account online, or they can request it by phone if they want to. So go to that online account and pull out that information because obviously things like unemployment you do need. You can request it electronically if they don't have a PIN number. They can call a couple of numbers listed there. One's a toll-free number to get that information to actually complete that return. A couple of things on the lottery tax credit. While preparing the return, if you notice a client didn't receive their property tax credit, um, there could be an opportunity to get help the client out. Now, this is not available if it was not used as a principal residence on or before January 1, but if they have their principal residence here in the state of Wisconsin and they didn't receive that, well, you can apply for that, the Form LC 100, to request a credit for their 2025 tax bill payable in 26. That credit is sometimes missed or not given to the taxpayer for whatever reason. You can be proactive and request that. If your property tax bill does not show the credit, you have until October 1 of 2026 to file and receive that credit. So the clock is ticking. A couple of court cases. We always try to throw some interesting cases your way. State of Wisconsin versus Griffin. It was a tax fraud and identity theft case. And from 2016 to 2021, this individual modified some W-2s and submitted them obviously improperly to the Department of Revenue. Charged with forgery, business identity theft, filing false income tax returns. It's great that they're catching these people, but it took them a while. Federal Defense and Accounting and Financial Services, where this individual was employed, they increased the Wisconsin tax withholding, decreased reportable taxable income, and basically got false tax refunds of over 14,000, evaded tax liability on another 22,000. So total restitution was just under $37,000 for the year. And it could have been a little bit higher, but the 2021 refund they requested about 2,300. That was identified as fraud before they even made the payment, and they blocked that prior to making any payment to the individual. So this individual's basically in some hot water. This is an situation where uh, jail time was warranted, 12 months in prison, extended supervision of 3 years, and total restitution, as I said, just under $37,000. The second case here, this deals with residency and eligibility for certain credits like earned income credit and homestead credit. We talk about people knowing how to work the system. Well, this individual didn't qualify as a full year resident according to the state, so they were looking at the 2021 tax year. Essentially, it impacts these two credits. The big one is earned income credit. The second one is the homestead. Here's kind of the timeline and how it shook out. For this taxpayer that had some children, they were in a refugee camp in Tanzania back prior to 2021. Now, they were conditionally approved for refugee status in 2019. And in November of 2020, the State Department sent a welcome letter and a travel packet. You're good to go. And the taxpayer was assigned to Wisconsin. That was the intended target. Well, February 16th, that's when she physically, taxpayer and the children physically arrived in the state. February 11th of 2022, they filed a tax year return for 2021, claimed the EIC and homestead credit. Here's the Department of Revenue position. Residency didn't start until February 16th, the date that you actually got here. That's why they denied the credits. The taxpayer's position, hey, got this welcome letter. The date of that welcome letter was November of 2020. So our intent was to be there. It just took us a while to make that move and establish residency. Well, here's what the Wisconsin tax law says. To create a new domicile, one has to abandon the old domicile, and two, intend to establish and actually occupy the new domicile. So because she wasn't here in time, Basically, intent doesn't cut it. It's insufficient to establish that you had residency for state purposes. You have to be physically present and occupy that new home. Didn't meet the test, doesn't get the particular credits. A couple other things to help you in your tax office. One, practitioner assistance. Do not share this information with your clients. Can't stress that enough. They will shut this down to practitioners if they get a lot of taxpayers that get wind of this website or a place to email rather, or the phone number. They don't want to deal with the public. They've got lines to help uh, the public with their tax questions. This is just for tax professionals. A couple other contacts. One of the ones that I've had some work with in the past is Nate Weber. They all do a great job. Amanda's been on some of the phone calls when they did have the stakeholder liaison meetings. Hopefully, the IRS will bring those back soon. And the homestead credit, of course, there's a number there and an email address. So there's the contact information that can help you get through tax season just a little bit easier on the state side. So from all of us at Back to Basics, wishing you a great tax season, and I'm hoping that it goes smoother than I fear that it actually will. So with that, I wish you all the best, and hopefully it's not a stressful tax season.